Hello, and welcome to today's webinar titled Double the Value of Your Business in 3 Years, Practical Actions for Making Companies Stronger, Sustainable, and More Valuable. My name is Mike Wilfley, and I'll be your moderator today. Today's webcast is brought to you by VCFO, a leader in finance, recruiting, HR, and technology consulting. We've been making companies stronger for over 20 years. I'm going to go over some housekeeping items with you. The webinar will last about an hour, which will include 45 minutes of presentation and 15 minutes of Q&A. If you have questions, please use the chat function located in the lower left-hand side of the screen, and we'll be sure to answer them at the middle and the end of the presentation during the Q&A sessions. This 1-hour course qualifies for 1 credit hour of continuing professional education. For those of you seeking CPE, we will issue a certificate to you based on your participation today. We will send you an email notification and an evaluation form. We'll ask you to complete that at your earliest convenience, and then we'll follow up with sending you a certificate. A recording of the webinar will be available on demand for viewing on the VCFO website, vcfo.com. Unfortunately, CPE will only be available to those who attend the live webinar today. For any questions on CPE, please use the chat function and we'll respond accordingly. As I mentioned, I'm Mike Wilfley. I'm the COO of VCFO. I've been with the company 4 years and oversee operations in all of our markets, including Austin, Dallas, Denver, Houston, and Seattle. I'd like to now introduce our speaker, Bill Hallfield. Bill is a professional manager, international speaker, business owner, published author, and board process authority. He led and funded a startup company, Penguins, which grew to over $40 million in revenue, 130 retail stores, and was sold to an international dairy company. Bill is the founder of The Board Group, TBG, which creates and manages advisory boards for privately owned companies. Business owners who have sold their companies after using TBG governance processes have realized over $3 billion in value. Bill has served on more than 35 boards and is an international speaker for Vistage, an organization comprising 20,000 CEOs worldwide. Bill is the co-author of Game-Changing Advisory Boards, Leveraging Outside Wisdom to Deliver Sustainable Value. And today we'll be spending time discussing sustainable value. Bill, thank you for being here.
Mike, thank you very much for having me. I'm looking forward to talking with all of you about a subject that is very near and dear to my heart, which is called sustainable value. So far, in the presentations I've made on this subject, we're in the area of $5 billion that owners feel that they can create if they follow this process. John Zeffel and I, who created this book, as Mike said, have seen companies sell for about $3 billion using, again, the board process and the sustainable value concept. As we talk about sustainable value, we're not talking necessarily, though, about selling companies. What we're talking about is building long-term value in your business and giving you the option as an owner or as an executive in the company to decide when and where and to whom you might sell your business and to do it on your own terms. In order to be in that strong position, when you're into any kind of a conversation about people investing or buying your company, we would like to see you be standing on a very firm basis called quantifiable trust, which is sustainable value. And that quantifiable trust comes from the company's ability to generate long-term profitability, long-term value, and long-term success, and convince other investors, other people, that future is very bright and very predictable. It may be a financial prediction, or it might be, how much do you trust me on what I tell you about the future of our business? We're going to take you through some steps now to explain this, and let me show you the agenda we're going to be working with today. We have several steps. First is to talk about sustainable value and how to double the value in 3 years. And we've done this with over 20 companies, and we just closed one in December where the man sold for more than twice his value in 3 years. It's a very live and practical application. We're going to talk about EBITDA and the multiple. EBITDA is earnings before interest, taxes, depreciation, and amortization. Essentially, it's cash flow, free cash flow. We'll talk a little bit about that, but the main focus of today is about the power of the multiplier, this thing we call turns. And when we change the multiplier, we create great value. The multiplier, again, is an indication of the future belief in the company. We're going to talk about sustainable value wheel and how that works. We're also going to talk about, if you have a strong sustainable value concept, a little bit on about how you might realize the value of your business. In other words, sell it or transfer it to another owner like family or employees or some investor. And finally, we'll touch lightly on advisory boards, the process of advisory boards, but we'll go very lightly on that because we're focusing on sustainable value. So I'd like to find out what's going on out there with the people who've signed up, and thank you so many of you who have signed into this webinar. If you go to the next slide, we'll see there's a multiple I'd like for you to do. You may have gotten this homework when you signed up for the webinar. Let's have a starting point. A starting point might be today, where is your value of your company today? And I'm going to make up a multiple of 6. What I'd like for you to do is jot down your EBITDA number, and let's say it's $1 million, and multiply that number times 6, and you come up with a value now on this particular slide in that box of $6 million. So 6 times your current EBITDA would give a $6 million value. So I'd like for you to make that multiple and go to this slide and check the box with your current company's value, 6 times your current EBITDA. Check that box, please, and send that in. And while that's going on, thank you. I can hear the pencils and the calculators going here. While you're doing that, that number that we chose of 6 times EBITDA could be lower in your industry. It could be higher. It could be a timing issue with many things going on around your company. But it's not an unusual number of 6 times earnings. So as we look at what is coming up, we're seeing on the screen a number of companies that feel we're in about the $5 million value. You see others that are in the area of 6 to 10 million, and some, a good 10% of the companies are saying our current value is greater than 50 million. But what I would like for this to be for you is the most valuable presentation you've ever made, because I want to double that value for you. The most valuable presentation you ever heard, sorry. And here's how we're going to go do that. Let me go to the next slide. I'm going to ask you now to take that EBITDA, take your EBITDA and multiply it by 1.5. So if it was $1 million, that now becomes $1.5 million. And then multiply that number times 8. So in this particular case, $1.5 million times 8 would give us $12 million. So in 3 years, in the lower right-hand corner of that box, it says we've now moved to $12 million from the former $6 million in valuation. So your increase in value is $6 million. And interestingly enough, that's double the value you started with. So would everybody do that calculation, please? Multiply your EBITDA by 1.5, and then multiply that number by 8. And look at the change in value between where you started and where you ended 3 years later with a growth in earnings and multiple. And while you're calculating that, notice how simple this is in some ways. Easy for me to say because I'm not doing the work that you are to run your businesses. But what we're talking about here is adding 15% a year for 3 years to your EBITDA. That sounds doable, right? And we're saying I can make my company more valuable. I can make my company more valuable by 2 turns somehow, and we're going to talk about somehow. How does that work? And out of that comes an increase in value that we'll see from this group. So if we had a way of doing a weighted analysis here, my guess is that probably with the people on this call, we're over $500 million in value that could be created if the sustainable value concept works for you. That should be worth your hour. And I can tell you, as I've done presentations around the country, and you'll show the next slide, I have found, for instance, in Denver on July 20th, we did this with 12 Vistage members. So we said, let's grow your earnings by 50% over 3 years, move your multiple from 6 to 8, and the number in the room was $1.08 billion. And the average, as I've worked with Vistage presentations primarily in small groups for 12 to 15 members, has been around $200 million in the room for 12 people. And this is what we're doing with companies every day. So how's he doing this? Sounds like an interesting formula, you might say. So let's look at this and say, okay, let's go to the next slide. How does this work? Let me give you an overview of this and then see what you think of it. Here are two companies that I've been on the board of. One, the names have been changed to protect the wealthy. We have the Backpack Company and we have the Plain Parts Company. The Backpack Company has a $5 million EBITDA, and you can see that it has a $60 million revenue. You can see that it has no debt, and you can look at those different characteristics down there. Good customers, is growing, got a stable industry, long-term management, family-owned. They've been around for 3 generations, actually, and they're good at manufacturing what they do. The guys on the right is called Plain Parts Company, and they have a smaller revenue. They're a smaller guy. They're $25 million, but they also have $5 million in EBITDA. They've got some debt. They're growing. They got long-term customer connections, several good ones there. They've got 1,500 products. They're in aerospace. They're family-owned, and they have some new management. And they have strong processes because they're in aerospace. So here's the interesting kicker. If you go to the next slide, when these are valued in the marketplace, either by an audit or sold, Backpack's value is $15 million. Plain Parts Company sold for $65, and it could have sold for $73, but they chose a buyer that fit their culture. So isn't that interesting? Here's two EBITDAs that are the same. A lot of characteristics are the same, but there's some hidden differences in here, or something that you, as an owner, or in your trade, if you're in the accounting world and in the CFO world, you might look at this and say, here's some reasons why one on the right would be a lot more valuable. I'd like for you to take a shot at this. Give us some comments. What do you think? Well, how could there be that much difference between two companies that appear to be pretty similar on that screen? What do you think? So send in some ideas while this is going on. Take a guess, and we'll see how you are. Oh, okay. Here come a couple of them. One says faster growing earnings. So yes, they're both growing, but the earnings are growing a little bit faster. If you multiply Plain Parts and it grows faster, you'll get more to the bottom line. Let's say return on revenue. Good call. So notice that Plain Parts has a much stronger return on revenue. They got a 20% EBITDA, and Backpack has roughly a 6% EBITDA. The gross margins actually that kick in there too. The gross margins that kick in are very strong for Plain Parts. They're about 60%, which doesn't show up on there, and gross margins is at 35% on Backpack. Let's see. Oh, there's an interesting one. Number of products. Somebody has heard this presentation before. Good catch. So there are a lot of parts over there on Plain Parts, a lot of products, 1,500 of them. One of the killer reasons why the Backpack company is worth so little is that they have one product. One product. All right, there's another great insight. Somebody says customer concentration. Wow, you nailed it. That customer concentration, again, Backpack has one customer. Everybody gasped all at once here. One customer, one product. And yet they're doing $80 million and making $5 million, and they've been taking home between $5 and $10 million for the last 25 years. They have one customer and one product. And those are two really big ones, really big ones. Let me touch on the next one, and then I'll give you a summary of this. There's one here that says the buyer viewed the management team in the process. Bingo, lights go on. If you walked into the room on Plain Parts Company, you would see a management team that's seasoned, has worked together for a long time, and they're strong. They're really bright. And at the center of that is the CEO that the owners brought in from outside, and they stepped back and said, we're not the people to grow this business. You are. They gave him 10% of the business, and he then did his job. He had to be there for a year or two before everybody could see how good he was, because he said, I'm going to do this, and then the company did it. So that's another reason for this 3-year window we're talking about, doubling your value in 3 years. But when the buyer saw this man and the team, they said, wow, we want them. Oh, yeah, and we want the company too. We want the company, and we can build on this management team. So there, I see you guys really nailed it. A lot of good insight here. let me show you what I would summarize this into on value multipliers for these two companies. If you looked at these two companies as being worth, at the beginning, 7 times earnings, the first 4 numbers here, 1, 2, 3, 4 on the slide, would tell you something about how the value grew. They have $5 million in EBITDA, and now how do you multiply it to see future value? So margins were higher, as you mentioned, on Plain Parts. So let's give them Plain Parts another turn. So they go from 7 to 8. Their management team is super. So give them 2 turns. So they go from 8 to 10 times earnings. A piece you can't see in this is that they are unique in the marketplace. We call this a must-have company. There's nobody else in the world that does what they do, and there still isn't after they were sold 6 or 7 years ago, and there still is no one else that does what they do. So that adds another 2 turns, because if you want to be in that business, you got to buy them. You can't even afford to go against them. And finally, the Plain Parts Company had a really strong systems, again, that you could build on. So a nice platform there for somebody to buy. Good systems, good people, right market, great margins, let's go. Our friends at Backpack, their customer concentration cost them 2 turns, and their product concentration cost them 2 turns. So instead of being able to get 7 times earnings, they're going to get really more like 3, and that's what their valuation came out as. They're making $5 million. Their company's worth, in the eyes of the outside world, about $15 million, and the Plain Parts Company's worth about $65 million, and sold for about that number, and could have been higher. So this is what we're talking about how to build sustainable long-term value, even on the same comparable EBITDAs. You can have wild swings if we do this thing called building sustainable value. Next slide, please. The value formula says, let's take the EBITDA of the company and multiply by some multiple, called turns or multiple, and out of that we get the value of the company, and hopefully it's very strongly sustainable. All right, what's the mystery behind this? Let's open up the curtain and go behind here and see what's going on. So as we go to the next slide, we're going to be talking about this thing called a sustainable value wheel. Here's the magic, or the compilation of the magic that you're actually producing out there yourselves. So the magic here is looking at the different segments of the business, and these are called value segments. And when John and I wrote this book, Game Changing Advisory Boards, we took all our learning and said, how can we put it into a model that we can show other people? So there are 5 segments. All about people and culture is one segment. All about business processes is another one. The other places, we got great people, great processes. Are we executing in the right markets? And under predictable revenue, instead of having one customer, do we have a lot of customers? Instead of having one product, do we have a lot of products? And that gives us predictable revenue. And finally, financial strength would have some pieces to it too, which we'll see in just a moment. All of these pieces, if they're working well and strong, in my vernacular, red, green, and yellow, and we'll see that in a few minutes, if they're really strong, then your sustainable value is really powerful, very powerful. Let's look at the next slide. So how do we break this down into pieces then? One way we do that is by taking each of these segments and breaking them into 3 pieces. In the north is about the CEO, the culture, and the management team. As we mentioned earlier in the Plain Parts Company, when you walked in, you saw the CEO and the management team and said, wow, I really want them, and I want to invest in them, and they're going to grow my business. That's fairly easy to think about. The strange one that I've run into a lot lately is culture. And there are investors out there and buyers, and you and me as people that might want to work in a company, we go and say, would we want to work here? And is this culture really something that is going to grow and is good for me as an employee or as an officer or as an investor? And the stronger that culture is, the greater the value of that company. So I'll spin around here and I'll come back and give you a little more detail. So you've got business processes. You have management information on that side. Is it good? How strong is it? We've got functional disciplines there and technology in that segment. So we're going to talk about those 3 segments. Then down below, we say in the right market category, we've got things like, are you a unique and must-have company? Do you have a good growth model? And are you in an attractive industry? Under predictable revenue, we've talked about the products and the customers, and then we also will throw in a discussion on customer relationships. and how long do people stay when they join you? In other words, what is your attrition rate, and what is how happy are they with you? And then finally, here's the financial strength. There are three different pieces to that: EBITDA, gross margin, and balance sheet. So let's go look at those in detail. When we do an in-depth assessment, we call it a sustainable value assessment. We do an online assessment and go in and ask these questions, which we don't have time to go into all the detail here. So we ask people to look at these questions and rate them red, green, or yellow. Green is really good, very strong. Yellow is like, no, it doesn't add much value. And red is, it takes away from value. All right, so how does this model work now? Let's go over to the next slide. So we start with sustainable value at its core, and then we look north, and we talked about those three factors a little bit. We have people and culture and management team. Now let me just underline culture again. There was an investor that I ran into in Dallas and at a presentation, and he kind of opened my eyes to that. He said, we own 17 companies. We can look at all the things on your value wheel, which we all agree with, but the key to us is culture, because if we were to buy that company, we were buying the whole company, we hold them for a long time, and if the people we would buy and their culture don't fit us, it's a mess. We end up having to fire people and change people out, and we're not getting anything for our investment. So the final decision is, does their culture fit us, and vice versa? And if it doesn't, we walk away from the deal. So it opened my eyes not only to how we should treat people just because we are good at treating people well, but also if somebody invests in the business, they will look at that culture and say, that's very attractive. So let's look at the next one. My eye-opening event in this sector was a woman in Calgary. I spoke up there about a year ago. And I said, what do you do? And she said, well, I'm a data wog. I said, oh. She said, I admit it, I am one. I said, okay, what does that mean? She said, well, my job is working for private equity, and what I do is I attack that blue piece you got there. When I'm a buyer, I'm representing the buyer, I go into a company, and I try to discredit these things in this segment. And he said, you know what? I'm really good at it. And I got a team that's really good at it. And we knock down the purchase price in general that's stated in a letter of intent. Generally, we knock down that purchase price by about 20%. Because we can prove from a big company standpoint that smaller companies' systems are not rigorous enough. And the more questions we can raise around management information and functional disciplines, the more uncertainty there is in the value. And now you've got a buyer who says, well, I can't pay you $30 million, I might, because it's kind of clear, the numbers are not clear, so I'll pay you 25. And that's how she makes her money, is discrediting your numbers out there and your companies that you own. If you sell, the last company we sold in December, there was a team of 8 people from Pricewaterhouse International that descended on my little $20 million company, and they were there for a week with 2 people, the CFO and the accountant. And the accountant and the CFO were ready to kill themselves after that. They were just exhausted. But that's what will happen when people go after your business processes. The technology piece is could be a game changer, and it could be that the process you run your business on actually becomes very scalable, and you could go national with it. You could use it as a platform, or just the technology itself has tremendous value. So that's a wild card that could be really strong. On the negative side, what I find is that people in smaller companies are slower to invest enough money in their technology, and often they have a dilemma. Do we spend $2 million more on our technology to get it up to speed in an ERP system, or do we just not, or we keep band-aiding it together and get to the next level that way? Next factor area is in the area of right markets. So easy question here. Since some of us from Texas, would you rather be in the oil market or the medical market right now? Obviously, oil's struggling and energy's struggling. Medical just seems to keep on rolling, and there seems to be a lot of money coming in long term. So as an attractive market, we're putting all this effort into the right markets, on the right market segments. We have a growth model that's scalable. And the last piece is the must-have company. I had a call from a guy named Lyle, who called me in June. He says, I'm on my way to Italy. I said, what's going on? He said, I sold my business. I just want to thank you. I got $40 million more. I got $40 million more for my company because during the last 2 years since we heard your talk, we focused on being a must-have company. And when we did, instead of getting $90 million, we got $130 million. So thank you very much. I was hoping he would send something more than just a thank you card, but we're working on that. Anyway, Lyle says that's where he found value. Next piece. The next segment is about diverse products, diverse customers, and customer relationships. We've already talked about the diverse products. My feeling is, and you probably have different numbers for yourselves depending on what industry you're in, but a product family shouldn't account for more than 20% of your volume in general. If you can get there, that's then you have some fallback if one of your product categories dies. Customers, I look at 10%. If one customer is more than 10%, I start to get nervous, and then if you're, but that might be out of your control if there are only 5 customers for what you do. Still, it's dangerous, and if you don't want a business with just one customer. And finally, customer relationships. What we're looking for there is what are the retention rates for your customers, and are they raving fans? In the companies I'm seeing, roughly retention rate above 90% feels pretty good, and a lot of people want more than that. Plain Parts Company, when they sold, they had 100% retention. Every dollar they spent with about 10 customers, there were contracts with those customers, and they'd been in place for 10 years, and all the contracts had grown in value. So those customer relationships were solid gold and helped them to get their stronger earnings and predictable earnings. And then in the next space of the financials, so all this wraps into a financial segment. A couple of things to note there. If a buyer looks at your company and they're a P&L person, they're an analyst, they're an investment banker, and they look at this part of your wheel and they look at your P&L, what tells them that you are an innovative company? We all kind of stop that. We want to be innovative. We are very innovative. Well, here's what happens. The gross margin in your company, if it's going up and it's stronger than the industry, then you are by definition innovating something, because you're offering to the market products that they'll pay more for than your competition, and they're willing to continue to do that, and you're changing your gross margin by being innovative with products or services or cost. So gross margin is where an investment banker looks to see if you're really truly an innovative company. In the EBITDA category, there are some step functions which we'll talk about a little bit later, but if your earnings are less than $5 million, let's say you would get a multiple of 6. I'm making that up. Let's make it 6 times earnings. If you were to go to 7 or 8 times earnings, then you would probably move up a notch. So you might go to 7 or 8 times earnings because you moved into a higher EBITDA number. The big number, magic number, is $10 million in EBITDA, and if you go there, then you would end up with a multiple that's much higher, and you might end up with a 9 or 10 times earnings because you have now $10 million in EBITDA. So there's step functions on the amount of the EBITDA dollars and their value in the marketplace. And then finally is the balance sheet, and in the balance sheet we know that there can be all kinds of assets. There also can be a bunch of liabilities, and it's something we have to pay close attention to, and hopefully our friends at Virtual CFO will help us focus on this particular segment very strongly, and also on the business processes segment, so that we can make sure that all the processes feed us good data and we end up with good financial results. Next slide is about, if we did this survey, I'm sorry, this is again a reminder. Here's the compilation. We've got these 5 segments. At the end of this webinar, we're going to offer you a free sustainable value executive session, executive assessment, and you'll assess your companies in these 5 areas, and we'll send you back a free report in this executive form in red, green, or yellow, and give you some overarching recommendations and questions to ask depending on the performance that you rate your company in each one of these segments. So look for that, and we'll touch on that a little later too. In the next slide, if you go into more depth and go deeper and do a more extended assessment, you go through all the questions online, and out of that comes a detailed breakdown by factor in your wheel, and it gives you ways to focus then and say, hey, get the red out. We're not a must-have company, we're a commodity. our functional disciplines are terrible. We got a bad CFO, and we got a bad VP of sales, and we need to change them out so that whole function runs really well. Or we need to train them and help them get to at least the yellow. But our disciplines need to be strong there. And then let's go to the future and bet on our greens. Let's bet on that and grow our business based on greens. So this is an overview of the question of the wheel. It's called a sustainable value wheel. We've done this for about 50 companies. There are a dozen right now that are using the wheel as to guide their discussions on, are the activities we are conducting in this company, are they building value, or are they only building P&L? Only building profit? Well, that's interesting. But are they building real value? So I'd like to ask you at this midpoint, do you have any questions about this sustainable value wheel or the two companies we talked about, or any of this thing about this general area of sustainable value and what you've seen? And if you'd send those in, we can take a look at them as we go along. And as you're sending in some questions, the usage of the wheel, if you decide to use something like this in your company, one of the biggest advantages is having everybody in your company learn about what builds valuable companies and dialogue about it, and give you as the leader their input on each one of those segments and each one of those factors, and say, these things are, we see these things as red and somebody else sees them as green. And now we say, well, what is your definition of this area, and what are you looking at to measure it? And in your company, then you've got this dialogue, a very rich dialogue going on. How do we really build value in our companies based on this model? And that's what several of the companies are doing. Okay. So I see a question here about do we recommend focusing on strengths or mitigating weaknesses? Yes. I think you need to pay attention to both. And the reds, well, here's one way to think about it. And we'll get to this a little later too. Who would care about the colors or the valuation in your model? If somebody, for instance, really values your entrance into the international market in Europe with your products, and you're a red in that area, you say, I guess we better get that up to a green, because the person that most likely invests in us or buy us would want to see a strong performance in Europe. So let's clean that up and get that up to green. If, on the other hand, another investor came in and said, we really don't care about Europe. What we want is to focus on the U.S. market share, and we don't care whether that's red or green. We don't care about the red there on Europe. All right, then you don't focus on it. You may shore it up a little bit, but you may focus on the greens that somebody else would value or that you value. And I think you step back and look at the whole wheel in general and say, where is the leverage in a business model? For instance, if you have a red CEO, that's bad. You need to get somebody to lead your organization. It's critical that block be green. And if you're in the wrong markets and you're working really, really hard and you're not making any margin and it's just terrible, you've got to get out of that market. It can't be red. So there's some fundamentals in there that need to be discussed. I see one other question here about weighting. We're going to get into the weighting a little further, and as I just mentioned, those factors don't have the same weighting. It might depend on how the bank looks at it. It might depend on how a private equity group might look at it, or it might depend on how you as employees, if you're buying this company as an ESOP, it might be looked at differently from each group. Okay. I think we could go on with questions. Let me show you the rest of the material, and we're going to have another set of questions at the end. Micah, do you have anything there that you see we ought to be focusing on?
Well, we have gotten some good questions, but I think you've answered a couple, and let's try to pick them up at the end if we have sufficient time.
All right, sir. You'll track those, and you can guide me where you want me to go. All right, so now we'll talk about, suppose you got the great wheel, and it's mostly green, and you focus where you want to go. How do we get realization out of this? Like a code word for selling or transferring. So here's the overview of that. Every company on this call today, and there's $500 million worth of increased value here if we do this right, every company will change ownership someday. That's the nature of things. And then the question would be, who would want it and why? And what would happen, how will this happen with your company? Suppose you're the owner, or you're the people that are the key shareholders. And then what would we do to ensure that the change happens on your terms and on your timing? So this is about, we've agreed to the concepts on the wheel, and now we need to do something about it. So let's give a little more context. What's going on right now? Woo-hoo, look at that bright orange column on the right. Today, as I understand it from several sources, there's about $1 trillion in private equity money. It's called dry powder. There's about $1 trillion in cash on public company balance sheets. And those two groups are out buying up companies all over the world. And they're going after our size companies, our $50 million companies. They're down to that size when instead of buying billion-dollar companies, they've gobbled most of those up and they're swapping those back and forth, either public or their private equity. Now they're in our playground. And they're paying somewhere between 8 and 10 times earnings. Again, we sold a company in December for 12 times earnings, and that company was bought by a Danish company who wanted to be here in the U.S. in the healthcare field. And that company had not grown, and its EBITDA was less than $2 million. So it's a little company, and they paid a big premium for it. So right now is a hot time. There's a lot of money looking for deals, and will it get better or worse? I don't know, but I can tell you overall that there are fewer and fewer of us as privately owned companies, relatively small, that are available. And if you're a must-have company in your niche, you're going to get something north of the average, and this is the average of about 8 or 9. So how are these factors weighed out? If I'm going to invest time and energy, as we talked earlier, where would I go to invest to get that high multiple? Invest my time and energy as a leader of the company or as a leadership team. We said again, there are value segments and value factors. There are people like competitors, the types of buyers who might buy us. There are private equity people who might buy us, or there might be management through its ESOP or through a buyout that would say we want to transfer the ownership from today's ownership to some future ownership. And one of those three groups would probably be the next round of owners. Or, you'll stay this way for the next 30 years and then it'll happen. So how do we then look at the weighting of these? And let's look at the next slide. The weighting of these segments and these factors. This is a chart that part of it came from one of the largest private equity companies in the country that I've worked with their board, their boards, helping them focus on these value wheel things. And here's what they say. Notice, let's take one in there, the center, the CEO and leadership team. Remember, I mentioned that the Plain Parts had a strong leadership team, and they got good value because of that. That value, if you have an average CEO and an average leadership team, you might get 0 above the average multiple paid for companies in your industry. So let's say you're getting 6 times earnings for the average in your industry. You got an average team, average company, you're going to get 6 times earnings. But if you have a strong CEO and strong leadership team that over a period of time, again, remember we're talking 3 years to double value, over a period of time they can demonstrate their strategic plan, their operating plan, their results, and their future, then you might add as much as 3 turns to your company. And that might mean instead of being worth 6 times earnings, you're now worth 9 times earnings because you built a great team. The thing I run into here the most is a private-owned company where the founder created it. He's 65 and he has nobody to sell it to, and he says, oh my gosh, do I bring in a CEO to run this or do I sell the business? And everybody can make their call, but there's some potential for great value here. Another one here is a must-have company. The private equity group I worked with said that is a deciding factor for them. They don't buy companies that are commodity-based. They don't buy companies that are commodity-based. They must have, they're unique. So that's their deciding factor. But let's look a little further. If you had all this discussion going on, and go to the next slide, please. If you had this discussion going on, what would you do with it? And then how do you get ready to either transfer the company or sell it or keep it. Either way. This is what we advise to owners, that they have a strong board, and we really believe in boards. Obviously, our book, Game Changing Advisory Board, says what we believe in. It changes the game. We have investment bankers we bring in. We have CEOs that we look for to say these are great CEOs. We have a transaction attorney that comes in early and says, you know, you got to clean up your house here, friend, because if you were ever to get refinanced by anybody, all this stock ownership and all the other stuff that's out there for in the legal world needs to be cleaned up. Or wealth management. How do you keep the money you get if you sell your business? And those processes need to go in at least 2 or 3 years ahead of time so that the tax laws work for you, not against you. And then there's a tax attorney. And all these people then are coming to you as service providers. The virtual CFO does a lot of this, and they bring in their people to look at what's going on in your company and give us all advice on the optimization of our realization. So we're looking at a case study. Let me show you how this would apply. This is the company we sold in December. When we walked in 3 years ago, 3.5 years ago now, this was the wheel that we looked at. Several really good greens. They got good culture, the CEO's good, strong financial segment in the medical business, great, strong. They've got customers that have been with them for many, many years, and they're a must-have company. There's only one other company in the country that can do this. Where they were weak is that they had a weak CFO, they had no VP of sales, and their functional disciplines in the sales area and in the financial area and the analytical area were all weak. And they hadn't grown for about 3 years. There was no growth there. Finally, they had essentially 1 or 2 products. But in the medical field, I learned a little later, that's not necessarily horrible if you're a strong must-have company. So looking at the next slide, when we took this company to market 3 years later, this is what the wheel looked like. So the wheel looked like a lot of green now, and the technology stayed about the same. We didn't invest in the technology. We consciously said we're not going to spend $2 million to upgrade the EBITDA ERP model. We're going to just keep slogging along with what we got because we know we want to sell. Our growth model was not so good, so we had to prove that. And then you can see the other 2 areas were yellow. We need to diversify products and add some different kinds of customers. So how did that play out over time? Here's one of those charts we love, up and to the right. So here's an up and to the right chart, just what we want. In 2009, we had the wheel on the left. The owner said, you know what, I'm 74 years old, I have a heart condition, and he literally said this to me, I want to sell this company in my lifetime, and I want to sell it for more than $15 million. And we said, clear direction from the owner, and this is serious. This is not like, well, I'll sell it someday. No, I want to sell it in my lifetime, and I might not make it for another couple of years. So in 2012, we put together a board of advisors. We drew up a charter. We decided pretty quickly that we looked at a SWOT analysis. They didn't have a strategic plan at that point. We got the value drivers in the business, and then we changed out the CFO. And we brought in a great guy. He was just tremendous and ended up adding a lot of value just as him getting everything in order. We also then brought in an investment banker in who said, like I quoted earlier, don't go to Europe. Nobody will value your products in Europe. The buyer will come from Europe. He already has the distribution, so we stopped international expansion. We put together, the team put together a strategic plan. We lined up the financial incentives, told management we wanted to sell this business, and we went into a new product launch. So those things rolled along, and notice how long it took. It took almost 3 years to get to the point where we were ready to go to market in early 2014. And what we got back was wonderful. We ended up with 5 people looking at it strongly, and the highest bid came in at $27 million. And this is for a company that had an adjusted EBITDA. And in the book, if you decide you want to read my book, adjusted EBITDA means everybody agrees it's EBITDA, both buyers and sellers. But the adjusted EBITDA multiple ended up being about $2.2 million, and the buyer offered $27 million. And then something happened. So go to the next slide. What happened? So we got into due diligence, and they attacked a bunch of things and said this is not as strong as we'd like. And they did attack our numbers. We were pretty good there, but they ended up finding things along the way that knocked down the value, which is what buyers do during due diligence. The big thing that happened is we didn't make our projections. Our projections, and this is I don't know whether this is a plot or not, but buying takes about 6 months, and during that time, management has to deliver as they go through the selling process every month. And what happened here, just before we closed, is they missed a month. And the buyer came back and said, "Wait a minute! After 5 months, you couldn't project 5 months out, and we're supposed to believe your projections for another 10 years? What?" And so they knocked down the price on that. The other thing that happened was that we had some legal challenges where it was a sub-S corporation, and somebody put stock into a corporation that they owned in the sub-S. And in the legal world, that nullifies the sub-S. Only individuals can own the sub-S. And therefore, the buyer said, "Wait a minute, what are we buying here? This is not the shares don't mean anything because it's not a sub-S corporation. It's something else." So that knocked another $1.5 million off of it because we had to convert it to an asset purchase. And then if any of you are thinking about selling, I've just learned again yesterday with a board we're on, the company sold for about $28 million. In the last 2 weeks of any deal, there's a lot of stuff that happens that's going to really, really tick you off as an owner, and it's going to drive everybody in the company crazy that's involved in solving it. In this particular case, the buyer came in and said, "If you want to be CEO, which we love you, we want you to be CEO, you need to give us $300,000, and we're going to put it in our bank account. If you're still here 3 years from now, we'll give it back." And the CEO, after we peeled him off the ceiling, said, "I'm out of here." And we had to calm him down and get it all put back together. And at the last part of it, they gave back a little money, saying, if you do well, we'll give you a little more money for the company after we buy you. And finally, the deal structure changed to an asset purchase instead of a stock purchase. And all those things combined to sort of a net value for the owner of around $22 to $23 million instead of the 27. But still, remember, his number was 15, and he got that, and he was ecstatic. So we're getting close on time. Let me show you just an overview here. And again, this is in this book, Game Changing Advisory Boards, plug. It's Exhibit A in that book. And these are the disciplines that drive the realization of a value wheel, the value of your company. If the things on the left and the right are working well and consistently and over a period of time, you as an owner, we as employees, and a buyer or an investor will say, "That looks really solid. Look at that. They got a great plan, great operating plan, compensation works, they got KPIs," all those things we talk about and the virtual CFO talks about when they come in to help you with your company, they're there. And on the qualitative side, what does it feel like here? Are we aligned? Is there energy here? Are we strongly ethical? Do we take appropriate risks? And all those things on the right. So as you look at your company, this is a really good checklist on whether you have a board or not. Are these disciplines active in our company? So a good checklist for you. And those checklists, we have a small assessment that we can deploy if you're interested, and that would give you some red, green, and yellow ratings on these. But again, you can see these in the book and take your own test and see what you think. So, let's get to a little closure here. You've heard a lot of stuff, and I apologize for talking so long. I'd love to see your faces and interact more with you. What are you going to do? You've heard some stuff here that we said is going to create $500 million in value. What are you going to do? Name one or two things that you could say, I need to take that action based on what you've talked about in the next year or 2 years, a long-term impact. Or what's one thing you can do in the next 100 days? Just one step. Go have lunch with an investment banker. Take an accountant to lunch. They love that. They'll show up for free food. I will too, by the way. So have the people, go get some help and look at what you're doing in your business and say, okay, in the next 100 days we can take small steps. Like I was in a board meeting yesterday, the small step was start a search for new salespeople because we don't have any great salespeople. And the CEO committed by the time we show up in 90 days, I'll have a list of candidates. Another person said, I will give you the KPIs in graph form so we can see over time how your KPIs are trending as a board, and we can give you better value for that. So what's one thing you can do? Jot it down. Writing it down makes it happen. I can see we got some coming up here. It's totally self-serving, but I love this one. It says Board of Advisors. And if you want to learn more about that, we'll give you some information in a minute about how to do that and how they can add value to your company. Develop a strategic plan, someone says, for eventual exit. So there are two things in there, by the way, in that statement. An exit plan begins with that, like our man said, I'm 74 years old, or 72, I got a heart condition, sell it in my lifetime. What is your exit timetable? What's appropriate to you? I mean, and what will it take for you to be happy and satisfied with an exit? And then look at the strategic plan that might support that. Would be a good way to go. I just lost my questions. Any questions, Mike, did you see there that you would want me to touch on?
We've had some really good questions. I think we've got time for at least one. I think one of the things that's come up a few times is, in talking about selling a company, what are some of the mistakes that people are making that hurt their value, outside from the focus on things to do right?
Well, I mentioned one that we consciously decided not to make a mistake. We all think that there's a value in ERP systems. And if we put one in, boy, they're going to tell us everything we know, and we're going to get really efficient and have great data, and we're going to double our bottom line because we got great ERP data. The negative of that is it takes at least 2 years and maybe 3 to see the value of an ERP system being installed. It's probably a $2 million deal that comes off your bottom line. And you might be doing something that builds long-term value, but if you wanted to exit in 3 years, I'd say a mistake is to put in a new ERP system tomorrow. And for another reason, many big company buyers really don't want your ERP system. They want theirs, and they'll install theirs after the purchase. So be careful of making investments here that you want to see a realization, in the short term. Don't make investments that might show up in value in long term only. Another big mistake is an owner says, boy, I think I want to sell this company, and as they get into it, they back off of it, and then they get back into it, and they back off of it. If there's not a dedicated focus to this building value, and again, I apologize, it's not just about selling, it's about building value. But if you go down this path, stay with it. And here's where the confrontation is going to happen. It's really going to hurt. You're going to be looking at a long-term employee. Let's say that yesterday, the guy's been there for 25 years. He's supposedly head of sales and marketing. And we look at him and say, you know what, you can't get us to where we want to go. You then turn to the owner and say, so how much are you dedicated to, how committed are you to building this value? Because it means changing out old Fred here for a brand new shiny model that's going to drive us forward. And a good answer would be, well, Fred has other things he can do in the company, and we really value him, so we'll move him over. But you have to be willing to make that call. And it bumps into the people part of it. The last piece I see is how much money do owners want to reinvest in the company versus take out of the company. If you're going to build this sustainable value, you probably are going to need to do some short-term investment and leave more money in the business than take it out, probably, depending on how fast you want to grow the value of your company. That can be a mistake to take out money and not invest in this value you want to create. I'll throw in one more. There's an easy answer here to build value. Let's go do an acquisition. And I've seen companies that are not prepared to do an acquisition, i.e. not prepared to understand the process, to evaluate companies, to integrate companies, and then to get additional value because they bought the right company. So it's something that's out there. You see it and say, boy, we could go buy a $20 million company. All of a sudden we double our bottom line and everybody's happy. And in my book, probably less than half of the acquisitions, and probably 75% of, I think the data is nationally that 75% of acquisitions don't reach the potential that they are advertised to do within boards or within companies. So 75% are not reaching that high end. They're reaching some lower number when they do an acquisition, and it could take you down. You could really have a bad one. What else?
Bill, let me point out that the slide we have up, that
okay.
We've had a number of people ask about the availability of the slides or the presentation. The slide as a deck isn't available, but the presentation will be on our website. But I'll let everybody know that we're offering this a free assessment, and with the assessment, they're going to get a good deal of the content of the presentation. So take a look at this.
Correct.
You'll be able to go to the website indicated and complete the assessment.
And then they'll get back a report from you, correct?
Correct.
And with some ideas about what to look at and maybe some action steps that would help them focus on building value, correct?
That's right.
Right. So, and also we're sending out an email to each of the participants here offering that same free assessment. So you saw the slide, but you'll also get an email from us to take the free assessment. So here's Mike from Duke University, and that's in North Carolina. And Mike says, you know what, you can't cheat the game. You got to be prepared. And I would offer to you this model, which in Dallas was $1.2 billion and today is at least $500 million. If you play the game right and make sure that you pay attention to all these, not only segments but factors, have good action plans and follow through, then you're going to be prepared to either keep your company running for a long time and sleep well at night because it's a great sustainable company, or you can invite investors in to give you money, or you could have employees sell it to an ESOP, or you could change the ownership based on your terms and on the valuation that you would like. So I'm very excited for you. I'm glad you got this, and I'm Bill Hoffield of the board group, and my sidekick here, Mike, from Virtual CFO. We're here at your disposal. We'd be glad to answer any questions either directly or online, and we thank you for your time here today.
Bill,
Mike, back
thank
to
you
you
very much. Bill, thank you. This has been a very informative session. And as Bill mentioned, VCFO and the board group are offering this complimentary 5-segment executive overview of the Sustainable Value Wheel. We'll send out an email to all the registrants by tomorrow. The email will include that assessment link and includes the Sustainable Value Wheel assessment. Once you complete the assessment, we'll send you a customized report. We have recorded this presentation. It's available on demand on our website. We'll send you an email with that link so you can forward it to colleagues who may have missed this today. And as a reminder, if you we'll be following up with you on email as well. If you're interested in CPE, complete the survey, and then we'll send you a certificate. Well, for both Bill, the board group, and VCFO, thank you for attending our webinar today, and we'll look forward to seeing you all again the next time we have a webinar. Have a good afternoon.